When you buy a life insurance policy, you are making a long-term financial commitment based entirely on trust. You trust that the company you're paying premiums expecting that they will be there for your family when it matters most. But how do you actually verify that trust? Is there any technique or data? The answer is yes. A number exists. It is called the Claim Settlement Ratio. And by the end of this video, you will know exactly what it means, how to read it correctly, and what else to check before you finalize any life insurance company. The Claim Settlement Ratio, or CSR, is simply the percentage of death claims that a life insurance company paid out in a given year, out of all the claims it received that year. Think of it this way. If an insurer received 100 claims and settled 98 of them, their CSR is 98%. That one number tells you in plain terms how often that company dispersed claims to the families or nominees. And here is the reassuring part. It is published every year by IRDAI, the Insurance Regulatory and Development Authority of India, as part of their official annual report. Every life insurer in India is required to disclose it. Regulated, verified, and publicly available. The formula is straightforward. So, if an insurer received 1,000 death claims in a financial year and settled 980 of them, their claim settlement ratio for that year is 98%. That is the number. That is all it measures. And understanding that boundary is exactly what helps you use it wisely. A claim settlement ratio above 98% is generally considered strong for a life insurance company in India. Most established insurers today operate in the 98% to 99.5% range, which means the vast majority of claims they receive are being settled. But here is where most people go wrong. They compare two numbers, say 99.1% and 99.4%, and assume the second insurer is meaningfully better than the first. That 0.3% difference across thousands of claims is statistically negligible. Do not let a marginal difference in the upper range drive your decision. What you should be doing instead is looking at consistency over time. A single year CSR can be influenced by unusual events, a spike in claims, a backlog in processing, or a particularly complex batch of cases that year. What you want to see is stable, high performance across 3 to 5 consecutive years. An insurer with a consistent 98.5% over 5 years is far more reliable signal than one showing 99.3% this year after 96% the year before. Use CSR as a filter, not a ranking tool. If an insurer is consistently above 98%, you can move on to evaluating other factors, which we will come to shortly. The official and only authoritative source for claim settlement ratio data in India is the IRDAI Annual Report, published by the Insurance Regulatory and Development Authority of India. This report is released once a year. You can access it directly on the IRDAI website, irdai.gov.in, under the Publications section. The data is broken down by insurer so that you can look up any life insurance company operating in India. A few things to keep in mind when reading this data. The numbers are always one financial year behind, so the report published in 2025 cover April 2024 to March 2025. This means the very recent performance is not yet captured, so you would want to look at multiple years rather than the most recently available single figure. Many insurance aggregator websites also publish CSR data, but always cross-check against the IRDAI source directly. To give you a sense of what strong performance looks like in practice, here is where Aditya Birla Sun Life Insurance stands in FY 2025-26. Individual claim settlement ratio of 98.86%. Group claim settlement ratio of 99.75%. For individual and non-investigative claims, once all documents are submitted, the average settlement time is 1 working day, provided you have submitted all the required documents. The link to the ABSLI's current claim settlement ratio disclosure is in the description box below. Here is the part most explainer videos skip entirely. The claim settlement ratio tells you how many claims were settled. It does not tell you how financially secure the insurer is, how smooth the claims process actually is, and how fairly disputed claims are handled. For that, you need to look at 3 additional factors. The first is the Solvency Ratio. Think of it as a measure of financial health. It tells you whether the insurer actually has enough money in reserve to pay out claims, not just today, but even if a large number of claims comes in at the same time. IRDAI requires every life insurer in India to maintain a minimum solvency ratio of 1.5. The higher the number above that minimum, the more financially stable the company is. It is a simple but powerful signal that the insurer can back up its promises with actual money. The second is Claim Repudiation Ratio. This is the percentage of claims that were outright rejected, not pending, not under investigation, but denied. A low repudiation ratio means the insurer is not finding reasons to deny valid claims. This number, when read alongside the CSR, gives you a much clearer picture. The third is the quality of the claims process itself. How accessible is the insurer's claims team? Do they offer a dedicated toll-free claims helpline? Is the claim status trackable online? Is there a relationship manager assigned to guide the nominee through the paperwork? These are not soft factors. They are the practical realities your family will face at the worst possible time. An insurer with a 98.5% CSR and a responsive, clearly documented claims process is more valuable than one with 99% CSR and no claim support infrastructure. So here's how to put it all together when you are evaluating an insurance policy company. Start with the claim settlement ratio as your first filter. If an insurer's CSR is consistently above 98% over 3 to 5 years, they pass. If it is below 95% or highly inconsistent year to year, move on. Then check the solvency ratio. It is comfortably above the IRDAI minimum of 1.5. A higher ratio means a more financially stable company, one that can pay claims even under adverse conditions. Then look at the claim repudiation ratio. A very low repudiation rate combined with a high CSR. It tells you the insurer settles claims readily and does not look for reasons to deny them. Finally, assess the claims process. Call the toll-free number. Check if there is a dedicated claims helpline. Read reviews from actual nominees, not just policyholders. The experience at claim time is the only experience that truly matters. At ABSLI, claims are a priority and not an afterthought. The claims team is reachable at 1800-270-7000. The process is documented clearly for nominees and the focus is on making sure families receive what they were promised without unnecessary friction. If you want to explore ABSLI's term plans and understand the claims commitment that comes with them, the link is in the description box below. The claim settlement ratio is one of the most important numbers in insurance, but only if you know how to read it. A number above 98% is a good sign, 3 to 5 years of consistency is a better sign, and a company that makes the claims process genuinely easy for your nominee is the best sign of all. Before we wrap up, here are the FAQs we get asked the most. Chances are at least one of these can be your query too. Here we go. What is the claim settlement ratio? It is the percentage of death claims an insurer successfully settled out of the total claims it received in a year. A CSR of 98% means 98 out of every 100 families got their payout. IRDAI publishes this figure for every life insurer annually. For FY 2025-26, ABSLI's individual claim settlement ratio stands at 98.86%, as reported in the IRDAI Annual Report. What is the solvency ratio in insurance, and why should I check it alongside CSR? The claim settlement ratio tells you how many claims were settled, but it does not tell you the full story. It does not tell you how financially strong the insurer is. For this, you need to see solvency ratio. Think of it as the insurer's financial fitness score. It tells you whether the company has enough money in reserve to pay claims. Not just a normal day, but even if a large number of claims arrive at the same time. IRDAI requires every life insurer in India to maintain a minimum solvency ratio of 1.5. The further above that minimum an insurer sits, the stronger their financial foundation is. It is one of the clearest signals that an insurer can actually back up every promise it makes. If you found this useful, share it with someone who is currently comparing insurance companies. This is exactly the framework they need. Hit subscribe for more videos that give you the real picture on insurance and financial planning.